So now let's start our first topic, first area, that is consolidation. Okay. So the word consolidation basically means combining. Okay. Combining or merging. So combination or combining the two financial statements or of the company, it is known as consolidation. So in consolidation, you have to merge the financial statements of the two company. Okay. We know that financial statements are of different types, like statement of financial position, statement of profit or loss, statement of change in equity, statement of cash flows. But in your FR course, you just need to understand how to prepare consolidated statement of financial position and consolidated statement of profit or loss. That's it. You don't need to be you don't need to understand the other consolidated statement, like consolidated statement of change in equity or consolidated statement of cash flows. Okay, so you just need to be aware of how to prepare these two. Okay. Now, as I told you, consolidation basically means you are combining the financial statements of the two companies or the multiple companies. Now, one of that company will be known as parent company. What is a parent company? A company that control its subsidiary. A company that is controlling its subsidiary company, that is known as parent company. Now, what do you mean by the word subsidiary company? A company that is controlled by parent company. So let's say, for example, you are a company A and I am company B. You are controlling me. So it means that you are a parent company and I am a subsidiary company. So a company that
Mm-hmm.
is controlling other company is a parent, and company that is controlled by is known as subsidiary company. Now there is a word control. What do you mean by that? You know, the control have a very wide definition, but from preparation of consolidated statement, consolidation for consolidation of financial statements, you just need to be aware of the shareholding part. Okay, we will talk about that wider definition as well, but just for the calculation purpose, that if one company is holding more than the 50% share of the other company, we say that the company is controlling the other company. Okay, so let's say you are a company A, you have 60% shares of my company. So it means you have a control in my company. Okay, you have a control. Control means you can change the decision of the company. You know, you can you can influence the control, right? You can influence the decisions of the company. You know, you can change the decision of the company. Okay, clear control definition.
Mm-hmm. Mm-hmm.
Then comes the
Yeah.
associate company. There's another company we say that is associate company. Associate company is a company in which a parent has significant influence. So there is a difference between control and significant influence. Significant influence means that you have a shareholding of somewhere in between 20 to 50% in other company. You will say that, you know, I have a significant influence in the company. Like there's a company A which have 40% shares of a company B. So it means you have a significant influence in that company, and that company will be your associate company. Okay. Now, there's a difference between control and significant influence. Control means that you have a power to change the decision of the company. That you have a power to, you can, you know, appoint the directors. Like you can change the decision making of the company. So you have the power. Okay. While the significant influence is like you can just influence the decision. You cannot change the decision. Like one example I can give you. Let's say in a company's board of directors, there are seven directors. Okay. Now, two of the directors you have, you influence those directors. So when there's a voting, you know, you can have two votes in any of the decision that a company is making. But let's say if you have four directors that you are influenced by you, okay, or that works according to you, so now you have a control, because out of seven directors, four are under your control. So when the voting will be done, you know, you will have the power to, to make the decisions as per your requirement, right? So this is how control and significant influence is different. Control means you have power to change the decisions, right, to decide according to you, while significant influence means that, you don't have that much power to change the decision, but you have a certain power, you have a certain influence in that. Okay, any
Mm-hmm.
any question you want to ask?
Oh, understand, understand.
Okay.
Mm-hmm.
Now, how do you treat your different types of investments in other company? Like, let's say if you have less than 20% shares in some other company, you will say that I have no power in that company, and that company is my simple investment, like, any other investment that I make. So you will treat that company, or you will treat that investment as a non-current asset. So if you have a less than 20% shareholding in any company, it means you have no power in that. That company will be just like your simple investment, and simple investment is a non-current asset. Okay. If you have 20%, somewhere in between 20 and 50% shareholding, you will say that I have a significant influence in that company, and that company will be known as your associate company. And what is the accounting treatment? We do an equity method of accounting, which is basically one line adjustment, which we are going to talk about. Okay. We will just record one line adjustment in our consolidated statement for the associate company. Okay, we are going to talk about that. Then if you have more than 50% shareholding in a company, it means that you have a control in that company. That company will be your subsidiary, and now you have to do the consolidation. So for consolidation, you need to have a control over the other company. And if you have a control, it means that you have to now prepare the consolidated financial statements. Clear?
Mm-hmm.
Now, what is the
Yes.
purpose of consolidation? Purpose of consolidation is to show group as a single economic entity. So the two companies which are individual in a sense, company A and B. Now, if let's say company A have hold 70% shares of the company B, so it means now you have a control. Now you will prepare a consolidated statements, and in consolidated statement you will show this as a single economic entity. Okay, single economic entity, or you can say that you will show group results, how the financial statement of a group look like, how the statement of financial position of the group look like, how the statement of profit or loss of a group looks like. So purpose of consolidation is to show the group, which means company A, company B, you have a control as a single economic entity. Okay.
Mm-hmm.
Preparation of the consolidated financial statement is the duty of a parent company. So it is a job of parent company to prepare the consolidated financial statements. Okay. Now let's take an overview of the consolidated statement of financial position first. Okay. Now obviously in the statement of financial position, what comes first? Non-current asset, right? Now what are you doing? You are basically uh combining the two statements, right? You are combining company A and company B's financial statement, right? Now, the first heading that comes will be non-current asset. In the non-current asset, first thing is PPE. What does PPE means? Property, plant, and equipment. Now you can clearly see I have write down the word P here, which means parents' property, plant, and equipment, right? Then S means subsidiary property, plant, and equipment. So it means that you will from the individual financial statement of the parent, you will take the parent's property, plant, and equipment. Then you will add subsidiaries property, plant, and equipment in that. Okay, because now you are combining the results, right? So a simple rule is just add up the figures of the two companies, okay, in the statement of financial position, and remove any intercompany balance between them. I will tell you why we remove that and how we will do that. Okay. So the simple rule is add items of both, right? You will be given the individual financial statement of the parent as well, and individual statement of subsidiary as well. You have to just merge that. So the first thing is you have to add all of the parents item with the subsidiary item, like parents property with the subsidiary property, parents plant with a subsidiary plant. Okay. So P means parent, S means subsidiary. Then I have write down FVADG. FVADG basically means fair value adjustment. We are going to talk about all of these one by one. So I've just write down the abbreviations here. Okay. So FVADG means fair value adjustment. Then you have to less depreciation. Then there is a concept of PERP as well. PERP basically means provision for unrealized profit. We are going to talk about that. We are going to talk about each and every adjustment. Okay. Then comes into intangible assets. Again, parents intangible assets plus subsidiary plus any fair value adjustment less amortization. Then comes the goodwill. Okay, goodwill is basically what? The goodwill of subsidiary company. So goodwill of subsidiary company, you will show that in the non-current asset section as well. And how will you calculate the goodwill? I have write down W3, which means working three. So it means you have to do a certain type of working to calculate goodwill. After doing the working, whatever the answer of the good will be, you will post it here. Okay. Then investment in associates, I have write down W6, which means working six. So it means, you have to do the calculation to identify the value of investment in associate, and whatever the answer you will get from that working, you will post it here in the non-current asset. Okay.
Mhm.
Let me show you how the workings look like. We are going to talk about that, but here is working three, goodwill. Using this working, you will calculate the goodwill and you will post the goodwill, whatever the answer you get in the non-current asset section in front of goodwill. Okay. Then the last is other investment. Other investment means, like, parent company, he had the other investment of the companies basically. Okay. Like, now let's say the first thing is written P means parent company's investment, S means subsidiary company investment, minus investment in subsidiary and associate. Now this is another important concept that you need to be aware of, that while you are doing the consolidation, if there is any intercompany balance, if anything that is amongst the both companies, you have to remove the effect of that. Okay. Any transaction which is between parent and subsidiary, you have to remove its impact. Okay. Got this point?
Mhm.
Now, parent's investment plus subsidiary investment minus investment in subsidiary and associate. Like, if parent company had made an investment in a subsidiary company, you need to remove that from the other investment part. Okay. And intercompany loans. Now, what does intercompany loan means? Intercompany loan means that one company has given the loan to the other company. Let's say the parent company has given the loan to the subsidiary company of $1,000. Okay. Let's say, for example, the parent company has given the loan and they are charging the, let's say, 10% interest on that. Now, if parent company gives a loan to subsidiary company, in return parent company will get what? Interest payments, right?
Mhm.
Interest. So now the parent company, in their individual financial statement, they would have recorded that in their investment section, because it is their investment, right, against which they
Mhm.
are getting the interest rate, right? But
Mhm.
in subsidiaries company financial statement, they would have recorded that in the loan category, non-current liability, because the party who's taking the loan, that is the liability for them, right? Non-current liability.
Mhm.
So they would have
Yes.
recorded that in the non-current liability. So because of the consolidation purpose, I am going to remove the intercompany loans from loan section as well under non-current liability, and from investment as well. Dual impact. Okay. One party would have recorded investment, other party would have recorded liability. So you have to remove that from the both sides.
Both
Clear?
sides. Mhm. Yeah,
Similarly, if
understand.
subsidiary gives the loan to the parent, you have to remove it from the both sides. Okay, from the investment and the liability. Done.
Mhm.
Okay. Then comes current asset section. In current assets, there will be inventory, receivable, and cash. You have to add the parent's inventory with the subsidiary inventory plus GIT. GIT means goods in transit. We are going to talk about that in a few minutes. Then again, the perp is there, unrealized profit. We are going to talk about that. So I will explain to you in detail. Then receivables. In receivable, you can see parent's receivable plus subsidiary receivable minus CIT, which means cash in transit. What is that? We will be talking about that in few minutes. Minus ICB. ICB means intercompany balance. Intercompany balance means that any balance that is in between the company, like for example, any receivable payable balance that is between the parent and subsidiary. Okay. So any intercompany thing you have to remove that. Like let's say, for example, the parent company has a receivable of $1,000, against the subsidiary company. So it means subsidiary would have recorded the payable and parent would have recorded the receivable, right? The transaction that they have done. Okay. So you have to
Mhm.
remove that from receivable and you have to remove that from the payable as well. Look, let's say, for example, parent company have sent goods to subsidiary company and amount and the goods are of, let's say, $200. So it means that parent would have recorded the receivable of 200, that I need to get 200 from the subsidiary, and subsidiary would have recorded the payable of 200, right? That I need to pay 200 to the parent company. Clear? Now, in the parent company's financial statement, there will be a receivable of 200. In the subsidiary company financial statement, there will be a payable of 200. So when you are going to do the consolidation, you will remove this intercompany current account balance from receivable and payable both. Clear?
Mm-hmm.
Dual
Yeah.
effect. Okay. Then comes the cash, parents company cash plus subsidiary company cash plus CIT, which means cash in transit. We will talk about that. Now, uh, then add the total of non-current asset. You will add it with the total of current asset to get the total assets. Okay, and total assets should match with the equity and liabilities. So this is how your assets section will look like. Any question you want to ask regarding that?
No, I understand. Mm-hmm.
Okay. Then comes the equity part. In equity part, you have to first record share capital and share capital of parent company only. You will just record the share capital of parent, not the subsidiary, just parent's share capital. Because parent have controlled the subsidiary, and because you are showing a group impact, you just need to record what parent's capital is, okay, and what parent's premium is. So in the equity part, you will just record the share capital of parent company and share premium of parent company only, okay. Then normally we add retained earnings, but here we will add group retained earnings. We will see what the retained earnings of the group as a whole are. And how will we calculate that? We will calculate that using working 5. W5 means working 5. So all of these workings you need to be aware of how to prepare them on the Excel as well. Because let's say if examiner will ask you to prepare consolidated statement of financial position, you have to prepare those workings, because using those workings, only then you will be able to calculate the figures and post them to the financial statement, okay, the format, okay.
Mm-hmm.
Then comes NCI, working number 4. Now what is NCI? NCI basically means non controlling interest. Non controlling interest. Now for example, let's say parent company have acquired 80% of the subsidiary companies. So the remaining 20% will be known as NCI, non-controlling interest. Those people or group of people that are not controlling the subsidiary, okay? Non-controlling interest, as the word is telling you, okay? So now you have to calculate the valuation of that certain thing as well, NCI. What you need to give into the NCI, okay? Because obviously, whatever whatever the profits will be, or whatever the loss is there, whatever the earnings is there, the NCI will have their share as well, right? Because the NCI also has also some shareholding in the subsidiary, right? So they will get something. If the parent company is controlling subsidiary, it does not mean that parent company will get 100% of the profits of the subsidiary. No, they will only get the 80% part. There are rest other people as well that have some shareholding in the company, right? So those others, they are known as NCI, non-controlling interest. Okay. So you have to calculate their valuation as well, and you will post them there. Okay. You will calculate that using the working number 4. Clear? NCI.
Mm-hmm.
Then comes non-current liabilities. In non-current liabilities, there are two things: deferred consideration and loan notes. Uh, we will talk about deferred consideration. We will talk about each of these things individually, because they are individual concepts. Right now, I am just giving you an overview of the format. Then comes the current liabilities, and well, you will add this equity, NCI, and liabilities. You will get total equity and liabilities. So this thing, total equity and liabilities, should match with the total assets, right? So this will tell you that
Mm-hmm.
you have prepared the financial statement in the right manner, when the answer will match. Okay. So this is how the CSOFP format looks like. Okay. Any question you want to ask regarding the format?
No, I quite understandable.
Okay.
Mm-hmm.
Now comes the workings that you need to prepare. Okay. Now, if let's say the examiner asks you in a question, in a long question, let's say that to prepare the consolidated statement of financial position, the first thing that you need to do is to prepare all of these workings. You know, so this is why the students, they are comfortable, or they always pray that I get the consolidation question in the exam, because you know how to approach the answer. In the individual financial statement, there are different types of standard. You don't know a set format that how to start answering the question. But in the consolidation, this is an easier thing, that when you will get the question, that the first thing I need to do is to prepare the workings. then prepare the format, and then post the things, right? So you know how to approach the question, or how to answer the question in a specific manner. Okay. So whenever you get the question of the CSOFP, the first thing that you need to do is to prepare the group structure. Okay, to do the workings. And the first working is group structure. You have to identify how the groups look like, how much of the subsidiary company is parent holding, what is the NCI, and if there is any associate company, how much you are holding the associate company's share. Okay. Then working to net assets of subsidiary. Net assets basically means asset minus liabilities, right? So the subsidiaries net assets or subsidiaries reserves, they are you will show them in the working number 2, while the group reserves, the group earnings, you are going to show them in the working number 5. Okay. Now what will you post in working 2? In working 2 you have to post the certain items on two dates: acquisition date and reporting date. Acquisition date means the date at which you have acquired the subsidiary, and reporting date means the date at which you are preparing the financial statement. Let's say you have acquired the subsidiary on 1st January 2024, and you are preparing the financial statement at 31st December 2024. So these two are the different dates, right? You have to post the things on the acquisition date as well and reporting date as well. Okay. First thing is share capital. Here you will prepare the share capital of, you will write down the share capital of subsidiary company only. Only the subsidiary company share capital. From the financial statement of the subsidiary, you will just post the subsidiary's share capital here. Okay. And share capital of the subsidiary at acquisition date and reporting date remains the same. Why? Because when we acquire the company, we say that for from group point of view, the shareholding or the share capital will cease, because now we have controlled the subsidiary company, right? So from group point of view, their share capital balance and premium balance will not exceed, it will cease. Okay. So share capital and share premium at both acquisition date and reporting date will remain the same. Got this point?
Mm-hmm.
Then you will write down the retained earnings at acquisition and retained earnings at reporting date. Then the fair value adjustment. What is that? We are going to talk about that in few minutes. Then depreciation charge, and then per whatever that is. Okay. So these are basically, this is what you will have to post in working two. Then comes the working three, in which we are going to talk about the goodwill, how to calculate the goodwill. Okay, we will do that in detail. But here I will just give you just an overview. Okay. So there are two methods to calculate the goodwill: fair value method and proportionate method. Here I have just write down the format, or I have write down the working according to the fair value method. The proportionate method we are going to talk about later on, okay, in the upcoming classes. So here in these workings, in this note, I have write down how to calculate goodwill and NCI using fair value method. Okay. Now, what is the goodwill? How do we calculate the goodwill? Let's understand that. You know what the goodwill is, right? It's the market reputation, right? Worth of the company, respect, market reputation. How do we
Yes.
calculate that using fair value method? The first thing is you will write down what the cost of investment is. Cost of investment basically means how much did you pay to get the holding of the company. Okay. Let's say, for example, you have hold 80% of the subsidiary, and for that you have paid $1,000. Okay. So this is the first thing that you are going to write. Second thing is fair value of NCI at acquisition. This is the acquisition date. Okay. And okay. So fair value of NCI basically. NCI is what? NCI is non-controlling interest. So if you have hold 80% of the shares of a certain company, the remaining 20% will be NCI, right? Now, what is the
Mm-hmm.
value of NCI? So let's say the value of NCI is, for example, let's assume it is 200. So it means that the total worth of the company, or total amount, you can say that you would have paid for the company, is $1,200. Okay. $1,000 that parent company paid to acquire the 80% holding of the subsidiary, And what is the worth of remaining 20% of the NCI? That is, let's say 200. Okay. So this will give you a total 100% valuation, or worth, or the investment that would have been done to acquire the company. Okay. You will deduct fair value of net assets of subsidiary company at acquisition date from that. Net assets of subsidiary company at acquisition date means these net assets. What what is the market value of the assets of subsidiary at acquisition date? You will deduct that. Okay, let's say for example, the market value of the net asset of the subsidiary at acquisition date are 800. So the difference that you will get is goodwill. Now try to understand this. The market value, fair value basically means market value of the assets of subsidiary company at acquisition date is 800, but you are paying $1200. Why are you paying extra? If the market value of a certain thing is 800, why are you paying 1200 for that? So we say that this extra amount that you are paying, it is because of the goodwill of the company. It reflects goodwill of the company. So this is the logic that you use behind how to calculate the goodwill. Clear?
Mm-hmm.
Okay. So in fair value method, you are calculating the valuation of the investment, 100% investment of the company. Like what you paid to acquire 80%, what NCI would have paid, what their value would have been. You will get the total 100% valuation of the company. And from that, you will deduct what the assets value is, the difference that you pay. You will say that is goodwill. Okay. And from that you have to deduct the impairment means the fall in the value, or the fall in the reputation, okay, of the company, that is known as impairment. So if there is any impairment given to you, you will deduct that. Let's say for example the impairment is $100. We are going to talk about the impairment as well in detail. There's a proper standard IS 36, but here impairment just basically means fall in the value of the assets. Okay. So you will get the
Mm-hmm.
goodwill at reporting date. You know what impairment is? You have an.
And I think I know it in Polish. Like it's if you're talking about the fall in the price of assets.
Yes, the fall in the decrease. Yes, fall in the value of asset. Yes, that is impairment. Exactly. Yes. Let's say for example, you had a car, okay, and
Mm-hmm.
the car had an accident. Now definitely its value will fall, right? It will fall. It will
Mm-hmm.
reduce. So that reduction is known as impairment. Similarly, due to the some factors, the goodwill can be impaired as well. Okay, the value of the goodwill can decrease. So that is impairment. Okay, so you will deduct that as well. Clear working tree.
Mm-hmm.
Then comes the working for non-controlling interest. First, you will write down the fair value of NCI. Now, the fair value of NCI will be given to you in the question. Okay, if it is not given to you, there's a way that you need to calculate that. But we are going to talk about that in the upcoming classes. So, just fair value of NCI means what the value of NCI is plus NCI share of post-acquisition profit. Now, this is the point that you need to understand. The difference between the reporting date net assets of the subsidiary and acquisition date net assets of the subsidiary, they are known as post acquisition reserves, post acquisition profit. Okay. So let's say the value of the net assets of the subsidiary at acquisition was 1000, and at reporting it was 1500. So it means that post acquisition, the increase in the reserves, or the increase uh, will be your post acquisition profit, that is 500. Okay. Now that 500, you have to share that between the parent company, between the parent and the NCI, because NCI is holding few percentage of subsidiary as well, right? If there is an increase in the reserves of the subsidiary, NCI will get their share as well. Have you got this point?
Mm-hmm.
So let's
Okay.
say the value of the net assets of the subsidiary post acquisition increased by 500, and parent is acquiring 80%. So 80% of the 500 is of the parent, and 20% of the 500 is of NCI. Okay.
NCI.
So
Mm-hmm.
whatever the NCI share is, you will add it here. Okay. NCI percentage multiplied by post acquisition profit. Okay. Then
Mm-hmm.
you will deduct NCI percentage of impairment. Like for example, here we have taken $100 impairment. So again, the impairment in the fair value method will be shared amongst NCI as well, right? Because they are also holding few portion of the company, right? They have some shareholding. So let's say if impairment is $100 and NCI is 20%, so $20 you will deduct it from here, 80% from the group reserves. Okay.
Mm-hmm.
Similarly, if there is any revaluation gain in the subsidiary asset, the NCA share of that you will add that. I will talk about the revaluation part as well in detail, but just giving an overview. So in this way, you will get the valuation of the NCI and you will post that in the main format. Then comes the group retained earnings. In this, first you will write down the parent company's retained earnings from the financial statement of the parent company, then parent company's share of the post acquisition profit that we just talked about. Then, if there is any associate profit, what is the parent company's share? Then, impairment, what is the parent percentage? Then, there is an unwinding, unrealized profit. We are going to talk about these factors one by one. Okay, this is just a format. Okay, the format how it can look like. Okay, now remember, after the class when I will share you the notes, if you have time, you can write down the format on your register as well, so you remember that. Okay, because remembering
Yeah,
the
sure.
format is key. Because if you remember the
Mm-hmm.
format, it will be very easy for you to attempt the question. Okay. Working six, we will talk about that later on when we'll talk about in associate in detail. Now let's go to the adjustment. Okay, so now it's very simple. I will explain to you adjustment one by one, and I will tell you how to post them in the main format. Okay, so in this way, we will begin with the adjustments. We will do each and every adjustment, and once the adjustments are done, we will attempt a full long question. Okay, of how to prepare the statement of financial position, consolidated statement of financial position. Okay, now the first adjustment is of intercompany balance. So I told you what is the intercompany balance. Out, I told you what intercompany balance is, which is basically uh, a balance in between the group, or a balance in between the parent and subsidiary company. Okay. Now, upon
Mm-hmm.
consolidation, the intercompany balance you have to remove that. Any kind of intercompany balance, you need to remove that when you are doing the consolidation. Okay, because you are not showing now intercompany effect. Now you are showing the group effect. Okay. Now, let's say for example, I gave you an example that parent company transfers some goods to subsidiary company. Let's say now parent company would have recorded a receivable, right? And subsidiary
Yes.
company would have recorded the payable. Let's say the receivable is 100, payable is 100. So when you are preparing the consolidated financial statement, you will remove this 100 balance from receivable as well and payable as well. Okay.
Payable.
But sometimes the receivable and payable figure will be different because of the reasons like cash in transit and goods in transit. So it means, your balance will not match. Like let's say receivable will be 100, payable will be 70, for example. Okay. So why? Because of the reasons like cash in transit and goods in transit. So in such a situation, first you have to correct the adjustment, you have to balance the figures, you have to match the figures, and then remove them from the main format. Okay. Now, how to do that? Let's understand this with the question. Okay. The first is cash in transit. In transit mean on a way, right? So it means that one company has sent the cash to the other company, but the other company has not yet received the cash. And because of that, their balances are differ, differing.
Different.
Okay, they're different. Got the point? So we will do
Mm-hmm.
what? Let's say, for example, the reporting date is 31st December, and on 29th December, you send a cash, and there was a public holiday for 1 week. Okay, for example. Now you will receive the cash, the other company will receive the cash in the next year, right? It means that one company has transferred the cash, but because of the public holidays, it was in transit, but the other party haven't received that, right? So it is cash in transit. So upon consolidation, we will assume that the cash is received, and we will make an adjustment. Okay.
Mm-hmm.
Now let's do the question. P company record shows a receivable of 15,000. So in the parent company's financial statement, there is a receivable of 15,000, while S company record shows payable of 13,500, and in subsidiary company they have recorded the corresponding payable as 13,500. The difference was payment made by S company which is not yet received by the P company. So the S company have made some payment, have some cash they have sent to the parent company, but parent company have not received that cash, and because of that, the balances are different, as you can see, right? Now how will
Mm-hmm.
we adjust that? Now what is the difference amount? What is the difference amount?
1,500.
Yes, so that is cash in transit. Okay,
Mm-hmm.
so upon consolidation we will assume that the cash is received. So when the
Mm-hmm.
parent company will receive the cash, what will be the double entry?
We
Debit,
need to deduct it. Mm-hmm.
debit cash, the cash balance will increase, and
Mm-hmm.
credit receivables, the
Yeah,
receivable will be
deducted.
reduced, right? Yes,
Mm-hmm.
got the point. So now
Yes.
after this adjustment the receivable will go to 13,500. So now the balance is matching, right? So now you will deduct 13,500 from the payables and similar from the receivable, right?
Mm-hmm.
And this is the adjustment that you need to post as well in the format. Your cash increased by 1,500 and your receivable reduced by 1,500,
Mm-hmm.
right? So you will do
Mm-hmm.
what? In the main
Interesting.
format, look, in the cash, I am adding the cash in transit. Why? Because it
We
is,
received the money. Mm-hmm.
yes, we receive the money, it is increasing the cash balance, right? While in the receivable, we are deducting
Deducting
that
it.
because it is
Mm-hmm.
reducing the receivable amount. Okay. So
Yes.
dual effect. Got the point? And
Mm-hmm.
then
Yes.
intercompany balance after adjustment, which is 13,500, you will remove that from here as well in the receivable and from the payable as well. So there are two things that you need to do. Okay. Once the intercompany balance matches, you need to remove that from the receivable and payable, and whatever the adjustment you did, you will post that as well. So dual impact. Got the point?
Mm-hmm.
So 13,500 receivable will be removed, 13,500 payable will be removed, and the cash in transit will be adjusted as well. Okay. Clear? Any question you want to ask?
No, no, I understand that. Mm-hmm.
Okay. Then
At
comes
first,
goods. Yes, yes,
no, I just saying that at first we adjust and after that we remove everything.
yes. And the adjustment also need to be posted in the format. This
Mm-hmm.
double entry, the double entry, they will not test you in the exam, but just for the conceptual point of view, I am writing down the double entries. Okay. Then comes goods in transit. So again, now there are some goods inventory that is transferred from one party to the other, but other party has not yet received that. Okay. Now how to adjust that? Let's see. Now parent company made a sale to the subsidiary company. In parent company record, there is a receivable of 15,000. So again, the parent company have transferred some goods to the subsidiary company and they have recorded the receivable of 15,000, while the subsidiary company have recorded the payable of 13,500. And the difference is due to the sum inventory that was sent by parent company but not received by the subsidiary company. Now parent company have sent some more inventory to the subsidiary company which subsidiary is not yet received. Okay, so that is why the balance is differing. So the difference amount is that. So what is the difference amount? 1,500, right?
1,500.
Yes.
Mm-hmm.
So goods in transit will be 1,500. Now upon consolidation we will assume that the goods are received. Okay. So when the goods are received, what is the entry that we will do? We will debit the inventory
Debit inventory. Mm-hmm.
and credit payables.
Payables. Mm-hmm.
So it means now your payable will go
It's
from
like
13,500 to
um,
15,000.
mm,
Right. So now the balance is again matched. Now you will post that in the main format. How will you do that? You will increase the inventory and you will increase the payables. Got this double entry? Got the point?
mm,
That your
mhm.
inventory will also increase of the subsidiary and the payable will also increase. Okay. So you will do what? So basically the goods in transit, you will add that to the inventory and payable both. Now let's look at the format. So here, goods in transit, I am adding that to the payable because it's increasing my payable, and I am adding it to the inventory as well. Got the point?
Mm-hmm.
And when the intercompany balance will match, you will remove that from the receivable, like 15,000 in this question, and from the payable as well, 15,000. So two things that you need to do. You need to adjust GIT,
Exactly.
and then you need to remove the intercompany balance. Similarly, in the case of CIT, you need to adjust CIT and then remove the intercompany balance. Got the point?
Mm-hmm.
Okay. These are the adjustments, you need to remember one by one, because if you will remember them individually, it will be very easy for you. And if you let's say learn the format, for example, then again the things will be more easier for you, because you know how the format looks like. So you know how can I post that, right? So that is why I was asking you to just learn the format or write down it, register, memorize that to make things easy for you. Okay. Anyway, with the practice, you will able to do it in better way. So now one more important thing. Now, sometime, let's say, okay, one thing, this you need to keep this thing in mind, that in the first example that we did, the subsidiary companies have transferred cash in transit, right? A subsidiary company has transferred the cash which parent company is not received, right? So it means that the company which have transferred the cash or transferred the goods, their record is correct, right? Because they have posted the right entry. The records
Mm-hmm.
of the receiving party or the receiving company, they are incorrect. You have to adjust that. So let's say in sometimes the examiner will just tell you what the payable, let's say the first example that we did, the cash in transit, he will tell you that the cash in transit was 1500 and the payable of the subsidiary company was 13,500. Now the intercompany balance in that case, is 13,500, right? Because the party which have transferred the cash, their record is correct. So it means that is the intercompany balance. When the other party
Mm-hmm.
will receive that certain thing, when you will do the adjustment, it will match with the subsidiary one, right? So sometimes, he will not give you the current account balance of the both companies. So this is a basic thing, but you need to be aware of that. Have you got my point?
Mm-hmm. Yeah, yes, that we should just watch who pays
Yes.
because
Yes,
like.
who pays or who have transferred the goods, right?
Mm-hmm.
His
Mm-hmm.
record, that company's record will be good. Company's record will be correct, and that will be the intercompany balance, right? Like in this question, 13,500 was intercompany balance, right? Not
Mm-hmm.
15,000. So sometimes the examiner don't give you the current account balance of the other company. He will just tell you the balance of one company, but you know that the company who have made the transfer, whether it is the transfer of the goods, whether it is the transfer of the cash, their records are correct. That is the intercompany balance. Okay. So if they have not given you the other company's current account balance, no worries. You know that this company's balance is correct, right? That is the intercompany balance. Got the
Okay.
point?
Mm-hmm.
Similarly, in the goods in transit, look, the parents transferred the goods, right? So it means that 15,000 was your ICB. Even if you do not know what the payable of the subsidiary was, you should know that 15,000 is ICB, is intercompany balance, because the parent have transferred the goods. Their record is right. Their record is right. That is intercompany balance. Okay. So sometimes the examiner don't tell you what the subsidiary company, let's say in this question, balance was. So you don't need to get confused. 15,000 is intercompany balance, because whatever the other company record is, after the adjustment, it will match the 15,000, right? So whoever is making the transfer, whether it is cash, whether it is goods, their record reflects what intercompany balance is. Okay.
Mm-hmm.
Next adjustment is fair value adjustment. Okay, you have saw the fair value adjustment word in the format in the workings. Now, what does it mean? Okay, subsidiaries, asset, and liabilities should be recorded at the fair value for consolidation purpose. So, fair value is basically market value. So, fair value adjustment means that when you are going to acquire the subsidiary company, upon the acquisition, their assets and liabilities should be recorded at market value. For example,
Mm-hmm.
let me give you an example. Let's say subsidiary company had a machine, and in their books, in their financial statement, the machine was recorded at 500. Okay. But when you did the consolidation and when identify the market value of the company, the market value of the company, sorry, the market value of the machine, the market value of machine was 800. Okay. So in
Mm-hmm.
subsidiary company's individual statement, it was recorded at 500. But upon consolidation, you saw that the valuation is 800. The valuation is 800. So it means that there is a 300 increase. So this is known as fair value adjustment. That when you will prepare the consolidation, you will increase the value by 300. Okay. So
Mm-hmm.
that is why you can see here first in the main format. Look, because it is the value of the assets that are going to increase. So you will add the fair value adjustment here. Okay. So parents asset plus subsidiary asset plus fair value adjustment in the example that I gave you is 300. It is not 800. Understand this, that in the individual books it is 500, right? So 500 you would have recorded that in this portion in the S, right? And then the extra 300 you have to add, that is fair value adjustment. Okay. Not the complete 800 here.
Mm-hmm.
Got this point?
Mm-hmm.
Okay. So this is fair value adjustment. Now, which, so now, when the value of the asset, non-current asset will increase, it means the depreciation charge need to be increased as well, right? Because
Yes, because we
if
have
asset
more.
value is increasing, right? So, for example, the example that I gave you, let's say the subsidiary company, and upon consolidation, so the let's say the carrying value of the asset was, let's say, 1000, but upon consolidation, you identified that its market value, or you can say fair value, is 1500, and remaining useful life of asset is, for example, 10 years. Now you will do what? The first adjustment that you will do is you have to increase the value of asset by 500, right? And then
Mm-hmm.
you have to charge the depreciation of that extra. So the remaining useful life was 10 years, so it means 500 divided by 10, 50. So this is the extra depreciation that you need to charge. Okay. Depreciation
Mm-hmm.
charge. So it means you will increase the value by 500 and then you will deduct 50 from it. Why? Because the
Because.
statement you are preparing at the reporting date. Okay. At
Mm-hmm.
reporting date, the depreciation is charged at the reporting date. So let's say you acquire the subsidiary company at on 1st January 2024, and you find out that the market value of a certain asset is more than 500. So you increase the asset by 500, and then at reporting date you will charge the depreciation on that portion, extra portion. Okay. Got the point?
Mm-hmm.
Okay. So
Yes.
this, so the net impact is of 450. Okay. So now how will you post that? There are two uh, dual impact. First, on the main format, the extra 500 you will add it here, and depreciation you will deduct 50. So 500
50.
plus 500 minus 50. Okay. One. And the second, in the working number two, assets, net asset of subsidiary. The in the net asset of the subsidiary, you are posting the subsidiaries thing. Okay. So fair value adjustment, you will do what? You will add 500 here as well, and you will add 500 here as well, and you will deduct the 50 depreciation here. Depreciation is deducted at reporting date only, because obviously we charge the depreciation at the end of the period, right? So
Mm-hmm.
I am adding 500, because at acquisition date and reporting date, the asset value is increased, right? So whatever the asset value was at acquisition date, you have to increase that by 500, and at reporting date as well by 500. Okay. So This is how you will do the adjustment. You can see it, and if any question, you can ask.
Okay, let's.
In the main format, in the property, plant, and equipment, add the fair value adjustment if value is increasing, and deduct the depreciation. In working two, increase the value at acquisition date as well and at reporting date as well, and charge the depreciation at reporting date only.
Okay.
Okay, so dual impact. Got this point?
Yeah.
Okay. Now, okay, so yeah, one more important thing. It's very basic concept, but sometimes student, they forget this. That let's say you acquired the subsidiary mid-year, and now you are preparing financial statement at the end of the year. So the depreciation now will be of 6 months, right? Because you have acquired the subsidiary mid-year and preparing the financial statement at the end of the year. So it means from acquisition to reporting, there are 6 months. So the depreciation, you will time apportion that. Okay. So remember this thing as well. So let's say in this example, if it would have been 6 months, then 50 multiplied by 6 divided by 12, 25, right? You will charge 25 depreciation.
Yeah, I get it.
Okay. Now it can be opposite as well. Let's say the carrying value of the subsidiary company's asset, it can be any asset, property, plant, and equipment, it was 1000. But upon consolidation, when you measure the market value, fair value, you find out that the fair value is 800. So it means now you have to reduce the value of asset by 200, minus 200. Got the point?
Mm-hmm.
So now in the main format here, you will not do plus 500, you will do minus 200, because now value is decreasing, minus 200. Got the point?
Mm-hmm.
That if value
Yes.
is reducing, you will reduce that. And similarly, in working two, you will reduce that here as well and here as well, in both situations. In the acquisition date as well and in reporting date as well. Okay.
Mm-hmm.
And now, if the value is less, it means that extra depreciation would have been charged. So we will add it back.
Added. Mm-hmm.
Yes. So let's say the useful life is 10 years. So the reduction in the value is negative 200. So you will divide it with 10. It will give you 20. So that 20 you need to add it back. You will add it back because extra depreciation would have been charged. Like, for example, carrying value was 1000 and useful life is 10 years. So depreciation charge would have been 1000 divided by 10, that is 100, right? But according to the 800, it should have been 80, 800 divided by 10, right? So it means 20 extra expense, $20 extra expense was charged. So you will add that back. And where you will add it back? In the main format and in working two at reporting date here
Mm-hmm.
in this area. Okay. So you will add it back. And in the main format as well here. Now it will not be the depreciation charge. Here you will write depreciation reversal or add back depreciation. Okay. So you will add it back here.
Here. Mm-hmm.
Got the point?
Yes.
So this is how the fair value adjustment works. Increase in value. If there's any increase in the value of the asset, increase that, record that increase in the main format and in working two. And because of the increase, charge the extra depreciation and deduct that from the main format and from the working two at reporting date, and vice versa. If there's a reduction in the value of asset, reduce that in the main format and working two at both acquisition and reporting date, and add back the extra depreciation in the main format and in the working two at reporting date only. Got the point?
Yes.
Okay, so this is your fair value adjustment. Then comes the perp, and this is the last topic for today's class. And the perp is basically provision for unrealized profit. So there's a concept of unrealized profit that we are going to talk about, and there are two types of unrealized profit. First, that arise because of inventory trading and second because of the transfer of the non-current assets, or you can say transfer of the fixed assets. Okay, so there are two types of perp. One that arises because of the inventory transfer between the parent and subsidiary company or between the group, and second which arises because of the non-current asset transfer. So now if you look at the main format here, you can see the perp here, right? In the property, plant and equipment section here, the perp. So this perp arises because of the inventory trading. Okay. Oh, sorry.
Mm-hmm.
As transfer of the fixed assets because it is in the non-current asset portion. But the perp that I have write down here in the here inventory part, this is because of the inventory trading. Okay. So if it is in inventory portion, which means because of the inventory. If it is in non-current asset portion, it means because of the non-current asset. Okay. So now this is the last thing for today's class. We are going to just talk about the perp of inventory, uh, and the fixed asset one we will talk about in the next class. Okay. Now, what is the perp? Let's start that. Profit made by dealing with the entity in group are recognized in individual accounts, but from group point of view, they are unrealized, and such unrealized profits need to be eliminated from consolidated financial statement. Now, in the consolidation, we are thinking from a group point of view, right? Now, we are seeing both the parent and subsidiary as a single economic entity. So, because of that, we say that any profits that we have earned, you know, due to the transfer between us, between the parent and subsidiary company, they are unrealized from group point of view. Okay, it's like taking out the cash from one pocket and putting it in the other pocket, right? Because now we are thinking like a group. So from group point of view, any profits that are earned because of the trading in between parent and subsidiary, they are unrealized and we do not account for them. We have to remove them. So that is why we say that they are unrealized profit. Have you got
Mm-hmm.
this concept?
Mm-hmm. Kind
L-
of. Mm-hmm.
Okay, let's say I am a parent company, you are a subsidiary company. I transfer you, I made a sales of goods to you, and I earned a profit of $200 from that. Okay. Now the inventory that I have transferred to you, it's in the group, right? You are part of group, right? And I have earned $200 from the sale. But from group point of view, I will say that this profit is unrealized. Why? Because we are just,
Because we're the same company right
yes,
now.
now we are thinking that we are a same company, or we are thinking that we are a single economic entity, right? So we will
Mm-hmm.
not account for that. So we will remove that unrealized profit.
Mm-hmm.
Clear?
Yes, it's clear now.
Now, if let's say, if for example, let's say parent company have transferred the goods to the subsidiary company, and now those goods, subsidiary company have made a sale to the third party. Okay. Now, what about that? Now the profit on those goods is realized because the inventory is further sold to the third party which is out of group. So when that goes out of the group, the profit becomes realized. So
Mm-hmm.
it means whatever the profit stays in the group that is unrealized, that is the one we have to remove, not the one that is realized. I will give you an example. For example, a parent company made a transfer to the subsidiary company and earned the profit of, let's say, $100. Okay. Parent made an inventory transfer or goods sale to the subsidiary and make a profit of $100. Now, subsidiary transferred 30% of that inventory to the third party. So it means that the profit that I earned is 100, but out of that, 30% inventory has gone out of the group. So the remaining 70% profit is unrealized, that is $70. So this is
Mm-hmm.
unrealized. Got the point?
Yes. Yeah.
So whatever stays in the group, whatever inventories in the group, profit on that is unrealized. Whatever inventories goes out of the group to the third party, this is not, that will be realized. It will not considered as an unrealized profit. Okay, got the point?
Mm-hmm.
Okay, now let's. do its adjustment. How do we adjust that? And two basic examples, and then we will finish the class. Now, the first is that if parent company make a sales of subsidiary, then unrealized profit is deducted from working five and inventory. Now, remember one thing: the profits of the parent company are recorded in the working number five, that is group retained earnings, group reserves. Okay, and the subsidiaries profits are recorded in the working number two, net asset of the subsidiary. So the subsidiaries reserves are recorded in working two, and parents reserves are in working number five. So if parent have made a profit and that is unrealized, you have to remove that from the working number five, because this is where the profit would have been posted, right? The group reserves of the parent. And
Mm-hmm.
if subsidiary have earned some profit, it would have been in the working number two. So you will remove that from the working number two. You have to understand this point, okay? Now,
Okay.
if parent have made a sales URP, which means unrealized profit, is deducted from working five, which is group retained earnings and inventory in the main format. Double entry will look like that: debit group retained earnings. Group retained earnings, you can say it's kind of like income thing. Normal balance is credit. When you are reducing that, you are debiting it. Okay. And inventory, you will remove that here as remove it, because
Because you
uh
gave me.
yes,
Mm.
so that portion should not have been considered. So the inventory, you have to reduce the inventory as well by that unrealized profit. Okay. And if it is from subsidiary to parent, then unrealized profit is deducted from working to at reporting date and inventory main format. So in both situations, whether it is parent to subsidiary, subsidiary to parent, you have to remove that from the main format in inventory. The other entry is what you need to see. Okay. So if parent has that profit, remove that from group retained earnings. If subsidiary earned that profit, remove it from the working number two. Okay. So here you can see in the main format here, perp. So whoever make sales, whether it is parent to subsidiary or subsidiary to parent, you will remove it from here. Okay. Now in the workings, if the sale is subsidiary to parent, I have write it down here. Perp S2P. S2P means sales is made from subsidiary to parent. Then remove the perp from here. Okay. And if parent have made the sales to the subsidiary, remove the perp here. Look, P to S.
Mm-hmm.
So that is why I have told you, if you can memorize the format, it will be very easy for you. Okay. So corresponding entry is same in both situations. You have to deduct the perp from the inventory part. Okay. Got this point?
Mm-hmm.
Now let's do examples of perp and then finish the class. So you know what markup and margin is, right?
Yeah.
Okay. So S transfer.
I
Yes. Yes.
no,
Yes.
no, I remember then in FA there was like a little difference when we counted.
Markup cost is 100%, and in margin
Mm,
selling price is 100%. Okay.
mhm.
So cost plus profit is selling price, right? So in markup, cost is 100% markup. And let's say the profit markup is 20%. So selling price would be equal to 120%.
Mhm.
While in the margin, let's say cost plus profit margin is equal to selling price. So cost 100% plus profit, sorry. If profit margin is, let's say, 20%,
Then the cost is gonna be 8.
yes, cost is going to be 80% because selling price is always equal to 100%. Okay, now let's do these two questions. S transfer goods to P. So it's a subsidy to parent sale at a price of 18,000 at a markup of 50%. So first thing that you need to do is to calculate the profit, and then you will see what the unrealized portion is. Okay. So 18,000, that is selling price at a mark of 50%. So it means selling price is equal to 150% because it is markup. And you have to
Mm-hmm.
calculate what the profit is. So 50 divided by 150. Do you have a calculator with you?
Yeah.
Okay, so what will be the answer?
What word? New one. Yes.
6,000 will be the answer.
Mm-hmm.
So 6,000 is your profit. Now the next line. Two-thirds of the goods are in inventory at the year end. So what will be the unrealized profit then? Two-thirds of the goods are in inventory. So how will you
The
calculate?
difference, like if we have two-third, then one-third.
No, 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 no.
No, so.
You have to calculate unrealized profit, which means what stays in the group. So
Ah, so
two-thirds of inventory
two-third
is in
of
the
that
group.
amount.
Yes, two-thirds of that.
Mhm.
So it will be equal to 4,000. So this is
Mhm.
your unrealized profit. Okay. Now the sale is from S to P. So from where you will deduct that? Because subsidiary has recorded that profit. So you will deduct that from working to at reporting date and the main format inventory. Okay.
Mhm. Mhm.
Then the next question, inventory of S includes 8,000 goods purchased from P. So whether it is P to S sale or S to P sale.
Sales to subsidiary.
Yes. Now
Mhm.
at a cost plus 25%, half of inventory is sold further to the third party calculate perp. So again, we have to calculate the profit first. 8,000 is the good value. And again, it is cost plus 25%, which means it's a markup. So 25 divided by 125. So what will be the profit?
8,000, it's 1,600.
1,600. And how much will be the unrealized? Half of inventory is sold further to the third party.
So half
Yes.
is left.
So
So half of that amount, basically it's 800.
800, yes. So times 50%. So 800 is unrealized. So from where you will remove that? The share is from P to S.
From working five.
Yes, from working 5 and inventory main format.
Mhm.
In both cases, you have to remove that from the inventory portion. While the other one, you have to see which party would have recorded the profit.